Hey everyone, Marty Mazzora here. Good morning, August 14th, 2019. I thought I should pop in on you this morning before the open. Look again at the chart, reiterate some of the things I've been talking about, and just overall concerns. I'm not going to get deep into the fundamentals. I'm doing that often on the blog. Clients, if you're watching this volatility and you're not reading the blog, then you don't know what we're thinking about it and why we're doing the things and recommending the things we are in your portfolio. So, if you've been inspired to watch this one and you haven't been watching lately, please make it a point to take the few minutes a day and start taking this stuff in. I think it's important and it's for you, quite frankly. Okay, so last video, we were looking at this nice big healthy green candle. That was last Thursday. And my position at the time is that this was kind of your normal snapback rally after pretty good noticeable downturn, kind of a washout down here last Monday. So we got your moves that really couldn't quite make it above here, and I mentioned back in here a day or two earlier that had to be some shorts piling up in here, particularly right here at the bottom of this, or right here at the top of this gap, and look for, a lot of pessimism out there. Look for shorts in here. And if we can get through that level with some momentum right up in here, then look for those shorts to have to cover. And then you're going to get an exaggerated bounce higher. And then I pointed to these Fibonacci retracement levels that are pretty key: 38.2, 50%, 61.8. Well, actually, as it turned out, we did have a close above it, but it was really the 50% retracement, which is all this one was able to get, at least so far. I actually expected yesterday to be the day where we came down, because again, the way I was presenting this was a decline, snapback rally, run into resistance, and then a decline further down, piercing these levels, and then we have conversations as we come down and hit lower levels. That was kind of my feel. Um, Looked like that was really set up technically to happen here, and then lo and behold, right after the open yesterday, we got the tweet. We got the notice from Washington that those tariffs that there were going to be no exceptions to suddenly got tons of exceptions and delays until December. And boy, did we have a good strong rally, although it didn't close near the high. It came down here, but it was still, I don't know, 400 points by the end of the day. And so again, kind of true to form. Market gets scary, market goes good, we get belligerent, market gets scary, we get soft. Still no boy who cried wolf for the market. The market seems to be taking it as it said and believing that, good things are about to happen on trade. We have to be getting skeptical by now. Now, I'm not gonna repeat everything I wrote in last night's blog or everything I've been writing over the last few weeks, but other than to say, and yesterday I did say that anything short of a complete reversal of all the new tariffs that have been added over the last year or so, and then a huge commitment not to go there with our other trading partners is going to do much to save this market, quite frankly, and this economy from the next recession and the next bear market. So, and I think that would be in the political best interest of the powers that be. Just doesn't seem to be much political will to get there. So I think the market needs to deliver, frankly, a lot more pain before it inspires that kind of action, even if it does then. My concern, and this is why we're actively hedging client portfolios with options right now, is that I'm not sanguine like I was the last quarter of last year and last December when the market was falling apart. And the simple reason, as I've illustrated in the blog, is the worst we got in our own index last December was a plus 22. Well, for 2 weeks running, it's below zero. It's a negative two. And that says recession risk is exceedingly high. And now, to add insult to injury, overnight, the 2-year Treasury yield eclipsed or went higher than the 10-year Treasury yield. Now, that's the yield curve I watch. Everybody's been talking about the 3-month 10-year that inverted quite some time ago. And I've been pointing to the twos, tens. Well, it inverted as well overnight, and that it has been one of the most reliable recession indicators since World War II. Now, doesn't mean a recession is right around the corner. It means a recession could be months away, and it doesn't mean that the market doesn't rise on emergency stimulus. And by the way, look for the Fed to get pretty aggressive right here. We may get 50 basis points at the September meeting. I think we will. If this yield curve doesn't come snapping right back, and if the data continues to deteriorate like I've been illustrating now for weeks and weeks and weeks on the blog, and we'll see how trade negotiations go. I think they're going to begin to sound conciliatory. I do think, as I wrote last night, that China believes they have the U.S. on the back foot, so they can play a little more hardball. But they do seem to be willing to talk here in person in Washington in September. So we'll see how that goes. But the chasm has widened greatly. They actually were on the cusp of a deal back, I think it was in June. And that got scrapped for a couple of reasons. Bottom line is both sides have the things that they want to hang on to. And in both cases, it's something that the other side is not willing to give on. So that creates quite the impasse. Somebody is going to have to flinch. A lot of the media is saying that Trump flinched yesterday, leaving his commitment of just a week or two earlier that we're adding 10% tariffs and there will be no exceptions, not even for Apple. It was quite the turnaround. And, I think the U.S. media probably had it right. And it was inspired by U.S. businesses who were just screaming foul. And the economic data, which again, we've been reporting on for quite some time, that's been deteriorating. China says it's a conversation yesterday morning with their lead negotiator who basically demanded that the US back off or it's going to get very, very ugly. Who knows? Maybe it's somewhere in between. You and I shouldn't care. You and I should just understand that tariffs have quite the ugly history in terms of what they do to economies, particularly when they are forwarded by the ultimate global leader, and that's the United States. So this morning, we have that inverted yield curve. As I speak, the Dow is looking at an open of about 360 points lower. Pretty good decline in the S&P. Folks, look for tweets. Look for, hey, we're getting along with China. I just talked with Xi. Look for all that. The government is going to make a valiant attempt to stem the tide in this sell-off that we're seeing, and they may succeed. You can see these tweets and these commentaries do bring money into the market. These are all rallies to be faded now. When you look at the economy and you look at the odds right now, as we sit here today, of a legitimate deal on trade. Getting rid of tariffs that haven't started yet, that doesn't fix the problem that's created all this deterioration in the data. I'll say it one more time. Anything short of going back to a regime where we don't have all these new tariffs that have been added over the last year, I don't think we can view as bullish for the market. And I don't think we should jump in and buy that. I think we should play it safe. I think we should hedge. I do believe still that if that scenario comes sooner than later, we could avert the next recession and the next bear market. But it's got to come pretty soon. You can see this morning. And again, things could change between now and the open. But this morning, we've had really good trade news relative to what we've had lately. We had a 400-point rally in the market. But since then, we've got confirmation that the economy has got some serious issues. And all that positive trade news is not able to stem right now what would be a sell-off that would completely wipe out yesterday's big rally. And that's the correct response in the markets. The trade war will not fix a recession that's already begun. I don't believe it's here just yet, but I think it's getting too close for comfort. And again, that's why we've hedged, the good majority of our portfolios so far. Some of you, if you're watching for the first time, we're trying to get your attention, but I think we need to do that. I think that's a smart move. The way to view it is under the circumstances, as cold as it's getting out there in relation to the economy and the markets, we want to wrap your portfolio up in a nice warm blanket using options. There is some downside, but it averts a great deal of the downside when we do it. If the market continues to get colder, you're going to feel nice, warm, and cozy. Now, if it starts ramping up and it ramps up with some momentum and it looks sustainable between now and January, unless we feel like we should unwind them, that warm blanket could feel like a straitjacket because These collars limit the upside. You'll get some upside, but not as much as you would get if we didn't have the collar on. But again, it really limits the downside in a significant positive way. And that's what we're trying to do, given the world as we see it, as I've been illustrating ad nauseum day after day here for quite some time on the blog. I'll leave it there. Thank you, folks, as always, for watching and listening. And of course, I'll be back with tons more. Take care.